ladies and gentlemen. Welcome to another episode of our Property and Finance podcast. Today we have a very special guest. We have Luke Berry, the co-founder of Thirdi Group, a very well-known property development company, or property developer, I should say, mainly focused in Sydney, you would say?
Yeah, it's been our bread and butter for years.
Yeah.
Sydney.
20 years in the making. We're neighbours too, actually. We've had developments all around us here in North Sydney. We've been watching your work from afar for many years, and more recently, Luke and I have become sort of more closely acquainted, you could say. And so I thought he'd be a great guest to get on board to our podcast to talk about a few things. Talk about some fundamentals that drive the property markets, and fundamentals we've spoken about in the past, but we'll dive a bit more deeper into them with some facts and figures and reasons for certain markets looking more opportunistic than others, and then also talk about your focus according to those drivers. So why don't we start with a bit of a background on Thirdi? Why don't we start a bit with the markets you operate? So Eastern Seaboard generally, right?
Yeah, look, it's been good to be here.
Yeah,
We've our businesses have grown in the same sort of time frame, so we've always admired what you've done here as well. So when Bob, Ron and I started 20 years ago, I didn't have the grey hairs that you can see now, and maybe that's a reflection of those two more than the market.
Yeah, you're like a Santa Claus today.
You bet. But look, we're 20 years in the Eastern Seaboard, so we've built some amazing projects in Sydney and Newcastle in Australia, and we've been lucky. About 5-6 years ago, we went to the UK. We're really giving the establishment over there a run for their money, and it's a similar market, it's got similar dynamics. It's a global melting pot of property enthusiasts, so it's helped us grow our business here and really cement our place over there. But we're known for commercial real estate around North Sydney. Not that we're doing a lot of that at the moment. Mixed-use development, so luxury apartments from $50 million penthouses down to affordable one-bedroom apartments in Newcastle.
And I've personally been through some of those penthouses. They look pretty fancy.
Yeah, very proud of them. And equally as proud as the smaller units, and particularly the SDA. We're one of the larger creators of specialist disability accommodation. So we've got a growing portfolio along the east coast of Australia, working with some amazing supportive independent living advisors like a Roomer, and we're very passionate about that.
Can we elaborate on that actually for those listeners that don't know exactly what SDA is? It's essentially fits within the NDIS.
That's right. So SDA is specialist disability accommodation, and within the NDIS there is a component of the budget or the funding allocated to help people with a disability live independently. So we build a lot of houses and villas and apartments that allow people to live more independently with elements within those projects that allow them to live comfortably with some support, some overnight supports. So it's something we started as part of the trial way back in 2010, I think it was. And we were one of the first to build it in New South Wales. And since then, we've gone on to do some great things. So lots to talk about that today. It's a great category to invest in when you do it in the right way. And then seniors living, we're building a beautiful retirement resort at Merewether in Newcastle. It's one of our first projects. We've got some of Australia's largest investment houses, real estate investment trusts investing with us on the creation of that. And then within our land communities, we do subdivisions of land around Wollongong and Newcastle, and we'll unpack why.
Can we just slow down there one sec? What is a retirement resort? Is it different to a retirement village? Or is it a fancy way of saying retirement village?
Oh, look, it's about the facilities more than anything. The Merewether Residences is on the golf course. It's 176 apartments, 1, 2, and 3 bedroom apartments. It's got resort style facilities. A village is typically a low density village that's set in their little mini houses or whatnot. So it's going to be a new unique value proposition for retirees. There's not a lot like it. And nothing against the village type. We actually have the manufactured home estates, the land lease model within our land communities as well. So there is an aging population in Australia, and we have a big problem. There's not enough houses to look after our baby boomers. And that's why we called it third age, which is that age of living, that when you retire, we need to build our forefathers and mothers beautiful homes because they did a good job raising us. So we've got a job to do, and we're very passionate about that as well.
Fantastic. So very broad there, very broad offering. Even the you did say you're not really doing it at the moment, but the dabbling between commercial and residential shows that you're seeing all sectors really, or two main ones at least. So I guess that's a good segue into, over the years, 20 years of operating, you've naturally got to gravitate toward different areas to focus on developing, right? To your point of all those various projects and focus points. I know you've highlighted a topic of today is these 6 drivers of the property market, which would naturally then influence those focus points.
Oh, without a doubt.
So why don't we start talking a bit about that and what they are and how they influence where both you and consumers should focus or property owners should focus?
Yeah, well, what I thought we'd share, my business partner, Bob, who is, if you see the size of his head, he's got a big brain, right? And he leads our acquisition strategy. And every year at conference, we go and present our strategy to our team to let them know where we're heading and why. Like, why are we going there? Where we're going to, why, where, and how we're going to get there. And the 6 fundamentals of property is supply and demand, it's consumer confidence, migration, so, the amount of humans coming in needing housing, interest rates, it's a big lever. When interest rates are in this high environment, people's confidence drops. So then government stimulus, which is another factor, comes into play, and then a broader economic conditions, right, of the market. So when we look at those 6 things, we then look at our layer. So third eye, we invest in infrastructure. That's the 3 I's in our name. So when we look at the data, every decision's based on data. We then try and find out what's the product. And so what are people going to want to live there? Is it a build to sell product, a build to rent product? Is it affordable housing? Is it a commercial asset? And then we look at the location.
Let's slow that down a bit because you're talking developer sort of jargon, I could say. So when you say you invest in infrastructure, I think that probably the better language to use for our listeners is that you follow it.
100%. Yeah. We follow where investments are getting made because that's where people are going to want to live and jobs are going to be created and value is going to be added to property. And we've got some insights that I'm going to share with your listeners now. But yeah, it's when you think about property, the numbers don't lie. We look at 2004 to 2024, in my opinion, was one of the hardest years in the last 5 years.
And why is that?
It was basically the hangover of COVID and the market, not just developers, but even consumers wanting to do an upgrade. You were battling enormous inflation, high record escalation in the cost of materials and labour. So to try and navigate that, you really had to work hard at trying to buy the property for the right price, like the land in our situation. And for maybe an individual, how much should I be spending on that house or that apartment?
Very tough time for developers, right, to make feasibility stack or just to have accurate feasibilities.
Yes.
It was a tough time to price jobs because the price kept moving on the job, right?
Oh, it was, honestly, I did get a few more grey hairs after last year. And it was a global thing. Even in the UK, we experienced the same challenges. The good news is for people looking at property is we think we're through the worst of it. I think what I want to share today is there are pockets within suburbs, within cities that are going to perform well. And if you can understand the data around that, then you can get strategic.
And these pockets are based on basically these 6
That's
drivers. They're not your opinion. They're not
No.
not your biased opinion because you know you've got interest in these marketplaces. You're focusing on these marketplaces for these drivers.
Oh, you without a doubt. Like if you, as an individual, you've got to get it right. Right, property is an expensive asset to get into and out of with all stamp duty, sales fees, and whatnot. Imagine trying to navigate it where you're trying to build 600 of them, you know, or 2,000. One of our projects is 2,000, and so if we don't understand those 6 key principles and apply it correctly, it's a very fast way to go broke in my game, right? And so we take it very seriously and very happy to quickly run through that. You know, the top one, you know, supply and demand.
Yeah, let's definitely run through that. Supply and demand, obviously fundamentals of economics there. But let's elaborate on that because that's been something that changes throughout the marketplaces across Australia and in recent years, constantly changing. So what interests you in the current marketplace?
Yeah, well, you know, we'll share some locations in Sydney and Melbourne that we in further in the chat that these all apply to. So it's never been harder to make projects work from a feasibility point of view. So the last couple of years, we've fallen short of our targets. So the government has a target of over 1 million homes over the next 5 years, right? And I think there's about 340 is earmarked for New South Wales. So when you break that down, that's 40,000 plus properties a year. Last year we only did 7,000, right?
This is nationwide.
Nationwide, 1 million. New South Wales 300.
Yeah.
So us and all the other developers in New South Wales, we've got a job to do. We've got to get out there. So,
sorry if I interrupt you there.
Yeah.
I just want to ask a question on that note. I've had guests in the past, a while ago now, talking about how that's fluctuated as well, right? So it's at 7,000 now, supply of new housing. Where once was it?
well, when I started, it was around 21,000 that was the target for the industry.
20 years ago.
Yeah, basically 20 years ago.
But it about 10 years ago, was it at its peak, right?
Yeah, it did. It jumped up to about 35,000.
Yeah.
And then now with this new target. So imagine you're coming out of COVID, you're dealing with record escalation, feasibilities aren't working, developers are shelving projects because you can't actually build them and make money because the market can't pay for the product because of the cost of delivery. And it's this compounding effect. So we're coming into an era where governments need to stimulate the housing market. And my prediction is when, Albo calls the election, there's going to be, housing's going to be a key principle for both sides. We've got to solve our housing crisis.
But no offense, I've heard it all before. Housing has been a political football in so many sort of past elections. Let's just highlight, though, that supply issue that you were saying, just to go back to that. So near 35,000 was the supply level once upon a time, call it, let's say, roughly 10 years ago.
Roughly, yeah.
And now we're at 7,000. So we're basically at like a fifth of where it once was. But demand, if we're going to highlight supply versus demand since then is probably, what 20, 30% more?
You bet, yeah. It's record. We've got net migration in New South Wales, so that means more people are coming than leaving. One of the biggest benefactors has been Queensland because it's beautiful up there and it's affordable. But yeah, the numbers, when I say 7,000, 8,000, that's completed last year.
Complete stock.
And then all that
Someone can move in and,
That's right.
Yeah.
And so the government needs to act. And I know it is a bit of a political football. We're seeing it with the New South Wales government. We applaud them on some of the changes that they've tried to make with planning, because that's the problem. To get something approved these days, you've got enormous challenges from local government and action group. Yeah. Then there's a lot of process to go through. And I think that there's going to be some sweeping changes to allow us to get large-scale developments and different types of developments like build to rent. That's why New South Wales is about to go in on a massive kick of BTR, build to rent developments, which we're participating in as well.
So let's just, sorry to keep interrupting, highlight some of those potential initiatives and what you're alluding to there. Because if we go back to the fundamentals that are limiting supply, and to your point, it's never been harder to make developments get out of the ground and make these feasibilities stack. There's a concoction of issues there. There's the price of the land in the first place to buy a site to build. Then there's actual cost of construction, cost of funding the construction with interest rates record high, and the previous cost of construction with record inflation. But fourthly, getting things approved. This is the part where you think the government can step in, where essentially you think state government could have more influence to just kibosh councils, right?
Yep.
Could they? And they've actually put things forward already, but it hasn't made any headway, right? Where they've put through these things like on a small scale for mum and dad developers, let's say, these overarching policies to do a subdivision, turn two houses into one that can be done in CDC. But on the larger scale that you're talking about, a whole block of apartments.
Yep.
Surely councils need to have a say.
Yeah. Look, there is a role for local government, and in case there's some councillors out there, we appreciate how hard you work listening. But the reality is that sometimes the alignment for state government housing accord targets, local government, and some local councils just focus on re-election. So then they're really beholden to minority groups that are anti-development, right? And that's not a big reveal with that. I think everyone appreciates it. What we find challenging with local government is that we often will submit a compliant DA, right? It's compliant on all the height, the bulk and scale, the setbacks. It's going to add diversity of housing to the local area. It's going to create more off-street parking. The urban form's going to improve, but yet an action group will form because they don't want any dust and disruption in their backyard. They'll then go and lobby the council. They'll go to their meetings and they'll cause get a lot of objections. And then all of a sudden, instead of the council standing up and saying it actually ticks all the boxes, we're going to approve it, they often refer us to court so that the court then approves it. Now that then adds 6 to 12 months of time, cost that then gets passed back on. And it's this issue of compounding the time it takes. So time costs money, the legal fees, the planning fees. And then if we just had councils that held their nerve in front of an action group and said, you know what, you live in a densely populated area. We need more housing. The housing these guys are creating will solve for X, Y, and Z. We're going to support it and not be worried that some minority group's going to kick them out at the next election. That's the problem, Theo. State governments have identified it. That's why they've set up pathways for developers like us that over $75 million in end value, there is a pathway for us to submit our planning proposals that don't bypass council, but definitely take the control away from them. And that allows us to get on with it and create housing. So there is merit sometimes. You're going to get frustrated with this comment, but there is merit sometimes in that, dust and disturbance is a real thing, right? And if a construction is going on for 3 years and you've just bought in the local neighbourhood and then you've got this, huge development going on in your backyard with trucks going in and out, it can be frustrating. However, on the flip side, talking about how much you actually work with local government and state government to create the right outcomes, you also do things to improve the area under these VPA, voluntary planning agreements, right? You bet.
So you're actually, appreciating the disturbance and the dust, we'll call it.
Yeah.
And you're doing things for the local neighbourhood that improves the area. Do you want to outline some of that?
Yeah, look, let's use a couple of examples. A funny story, I had a really prominent site on the water in Sydney surrounded by very wealthy, educated individuals that said, we're going to form an action group, you're never going to get this approved. And they caused us a lot of issues on the planning pathway. We ultimately got it approved, built it, delivered it. It's now one of the most iconic projects in this particular part of Sydney. the funny side of the story is one of the committee members on the action group wanted to buy one of the apartments as soon as it got approved because they were hell-bent on stopping it if they could. But then as soon as the tide turned, they then put in their expression of interest to buy one. And when you're dealing with that mentality, it's hard to actually get in and add value for the broader community, right? And that's what a VPA is all about, is that, using Crow's Nest. We're very proud of the process we went through with Crow's Nest Overstation. So we bought that development. It had an element of build to sell, 130 apartments called Elevate. It's going to be one of the best located places to live in Sydney, 10 minutes to the CBD, 4 minutes to Chatswood. And we bought that and it had 45,000 square metres of commercial next door to it. Now, if anyone lives around Crow's Nest, that's the last thing Crow's Nest needs is bloody 45,000 square metres of office with no car parks. A nightmare. But anyway, through planning, that's what was approved. We bought that. We then worked with the state government in a number of groups, unions, the Nurses and Midwives Union and the Health Services Union. And very proudly, we sat down with the government and said, it's the wrong type of use. So through a VPA type scenario, we amended our plans and we're now building about 58 apartments for nurses that is given as a contribution in perpetuity that's managed by a community housing provider, Evolve Housing in this case, and we're building 420 build to rent, so purpose built for renters to live in Crow's Nest, right?
And much more appropriate for the area.
Yeah, 2,000 square metres of amenity, retail on top of a metro. So that is going to transform, and the ripple of that development for the community is going to be immense. And that's good development.
I can only imagine the amount of meetings and proposals and planning that went into changing from one to the other.
We did 145 meetings in 7 months.
Wow. So 7 months actually is not too bad.
Yeah.
That's actually
maybe 9 months with throwing Christmas there, but
because if you think about it, I think at the moment the average DL across Sydney just for a residential development, just for someone converting their home and getting it approved, or developing their home and getting it approved, it's about 9 months or something.
Yeah, and I feel for councils, they are under resourced, and the planning, they've got to get it right. So they approved Johnny, next door, and he gets an enormous extension that can set dangerous precedents for the rest of the street. But the frustrating thing is that Johnny's extension at the back can sometimes hold up a project of mine that's going to build 100 apartments, and that's where it's broken, And so we've got to get that solved, and that's where this supply and demand, if we can, if
the government could step in.
Yeah, if we can get some alignment with state and local government, I think the federal governments, there'll be a range of housing policies. I like the way that our federal government incentivises councils, or maybe threatens in a way that if they don't provide enough housing for those targets, they're going to miss out on their contributions or their pieces, what the government pays them.
And it's getting some airtime. Like you said, there are a little bit more initiatives being discussed and workshop. On the house and land subdivisions, for example, something that's getting a lot of airtime is loosening up the ways of construction. So things like modular construction is becoming potentially acceptable for CDC in certain councils in subdivision, because we don't have enough builders to build homes in certain areas. And some of these modular constructions are like for like and cheaper. But yeah, so that's one of the 6. So we should move on, right?
We can do a few quickly there.
Yeah, so let's elaborate on them all, because they're great points, and it's exactly what our listeners want to hear about, especially because they're relevant regardless if you're looking at one of your developments or not. It's just relevant to consumers wherever they're buying a home and decisions or investing. So let's talk about the next one, consumer confidence.
Yeah, well, look, it goes hand in hand with maybe interest rates at the moment. We've got record high interest rates. People want to see where interest rates end up because it's all about affordability. So I think it's pretty low at the moment. to be honest. You've got to work really hard to get someone to buy off the plan. There is, and one of my favourite humans is David Milton from CBRE. I know you know him well.
Yeah, he's a fantastic operator.
Amazing.
He's actually has alluded to some of these, or not alluded, but covered some of these points in the past, and he's the one that I touched on before. Gave some really good insights to the supply and demand fluctuations over the years, which are drivers. But yeah,
and I talked to him about the market, and it's hard right now. People aren't confident. They don't know where the inflation's going to go. The cost of living's record. So interest rates are going to start tipping. So, when the consumer confidence comes back in, that's when people will start turning up to auctions and buying or trading, right-sizing, downsizing, so that they can get some certainty around it. And
it's amazing how quickly that can flip, though, confidence. As in right now, sentiment is a bit weak and consumer confidence is debatable. But it changes overnight.
It does. A couple of interest rate cuts, everyone's going to be a lot more confident about their ability to service. And one of the first keys for anyone listening is it's all about affordability for the next 5 years. And we've got some tips about what to look for. So once the consumer confidence gets corrected off the back of interest rates, migration is going to continue at those record levels. I think we're on track for 250,000 this year, maybe up to 375,000. Immigration's a lever that federal governments pull in elections, so let's just see what happens. But the reality is the migration data, it's the reason we didn't tip into recession, because we had more people coming into the country during the tough 4 years, and technically we didn't go into recession because of that. But, I think that's putting pressure on housing. And off the back of those 3 points, consumer confidence and interest rates, migration's happening. It's net in Sydney and Melbourne. We see a lot of people going down to Melbourne because it's more affordable, but all those pockets within suburbs that are going to perform in Sydney because of affordability,
So when you say net, elaborate to our listeners, essentially meaning that people are also moving into state for affordability reasons.
That's right.
And leaving these cities.
That's right. So every state loses and gains. And I think Melbourne has been a big loser because of what's gone on down there. I've got a lot of friends in industry. They've had it the worst of anyone in the country, in my opinion, because of some of the escalation they're dealing with, some of the planning outcomes. The state government had their own views on how things should be managed, and without going down that rabbit hole, but they were losing more people than going, right? So with New South Wales, we're actually growing as a state, so we're having more people come here than we're losing, and that's good for property investors, and it's good for property values in the long term.
Just want to touch on something with that consumer confidence comment in the current market at the moment. It's interesting. We saw some data come out for January, for Sydney in particular was the data I was looking at. And we saw 45, I think was the number, 45% or thereabouts, close to over 40% increase in new listings, supply level, compared to the same period last year. Some might say, was that an anomaly last year? Was it a record low? And no, last year was not record low. It was actually slightly higher than the 5-year average. Although January typically hasn't historically been the most common time to list a property, but there was a bit more listings starting at early Jan this year, which might indicate some interest rate pressure. But it was still met with decent sales results. It was still met with decent auction clearance results, and things took longer to sell. There were longer days on market across the marketplace, but confidence is still okay.
It's not too bad. I think I think everyone is like a sigh of relief. We've sort of navigated this high inflation, and everyone knows Mark Boris. He's a great commentator on the market, and I think he did a podcast recently and summarised it. The population did well. Like we bought as a collective, we've brought inflation under control.
Mm.
You know, we've all tightened our belts up. So I think the confidence is returning. That talking to some of my sales mates, a lot of people were just hanging on there, and they just got through Christmas, and they're like, right, interest rates are starting to come off. I'm going to get my property ready to sell because confidence is going to come back, and I'm going to be able to create the exit because I held on to it all the way through the tougher period.
Mm.
And I think you'll see a bit of that in the next couple of interest rate drops.
Well, just to circle back to these drivers, we've covered now 4 of them. You know, supply and demand, consumer confidence, migration, and we somewhat covered interest rates, but we talk about that a lot on this podcast. We don't need to elaborate on that too much, but naturally that's a driver to price growth. And we are at the top of a downward interest rate cycle, so that should improve affordability naturally and improve prices subsequently. Next one, government stimulus.
Yes,
that's the big one.
It is, and just a couple of things to read off my notes here. So if people think back in 2008, 2009, it was the GFC, right? Or after the GFC, and it was a pretty challenging time. We started in 2006 and 7. Who would have thought that 2 kids from Gunnedah and a mate from Sydney, 24 years old, I get called racer because I love my horse racing, and that would be a pretty good each way bet. We'd be standing here today. But I remember back then they did a $7,000 extra for existing homes and a $14,000 extra for new builds. Off the back of that stimulus, there was a boom, right? There was a property surge, particularly in house and land. So that was the government reacting to the GFC.
There was actually a couple. I worked at Commonwealth Bank back then in the branch land, and there also was that's when they first introduced the first home buyer grant.
That's right. Yeah,
it wasn't much. I think it was between $7,000 to $15,000, but it made a difference.
It moved the needle a lot.
Yeah, I bought my first property in 2009 because I jumped on that bandwagon. I saw that everybody was using the grant to buy homes, and I could sort of contribute a decent amount to your deposit to buy your first property.
And this is what we're tracking, is that you're a classic. I did the same thing in Cardiff, near Newcastle. I built a house and I used the grants. Then in 2020-21, this is from COVID, that was the home builder scheme. The federal government provides $25,000 grants for building new homes, all major renovations. Now, the impact on supply, new home sales surged 77% off the back of that.
Let's elaborate on that, because that could just be someone buying a brand new development off you, right?
That's right, yeah. Or, particularly in house and land, or going to a builder like those amazing boys at Next, McDonald Jones or Mojo Homes. We do a lot of work with them in New South Wales. Off the back of that, there was an enormous run of new homes because the government was providing that. And the multiplier for the government on employment off the back of construction is enormous. And then that just gets the cogs in the machine turning, that people are getting paid to build these homes. 2021 saw a record year for detached housing commencements, peaking at 143,000 new builds, and that's ABS data. So There's 2 government stimulus. Now, the latest one, which we want everyone to understand, is the National Housing Accord targets. That's what I talked about previously. That's the federal government's commitment to build 1 million homes from 2024 to 2029. Here we are, 2025. Not much has happened last year because of escalation. We've got an election coming up. They've got a term to deliver on these targets. So property investors, smart ones, are going to benefit from it if you can understand the ripples, right? And that's what we as a developer have spent hundreds of thousands, millions of dollars on data to know where the ripples are going to be. And happy to share a couple of ideas with the listeners following that. So that's the driver of the property market. The Housing Accord targets. It's going to be a very interesting time. We see land. Now, we spent hundreds of thousands of dollars with the Newcastle University to track migration data on where and how far people would be willing to move for affordability. And coming back to that word, that's key. And
When you say affordability, also for land, as in you got to price up a unit versus getting a house, is
Yeah.
what you're basically saying.
and when you think investment, you've got to think, right, how much is someone willing or able to spend on rent? So you're the numbers guy, right? You've got a median wage or an average wage in Australia around 120,000, I think it is.
It jumped a lot in recent years.
So let's just use that number. Median, they can afford a $1.4 million property off that income. Now, where can you do that in Sydney? Maybe Melbourne and Brisbane. So when you're thinking New South Wales, you've got to go where the data's telling you. And that's why we've gone very heavy in around Wollongong. We've gone very heavy around Newcastle. It's a patch of dirt that we've done, multiple developments, thousands of properties. And, we've got a growing portfolio of land, and it's the edges of those land investments that's going to benefit when we go and spend, hundreds of millions developing that land. And that's where the ripples are going to occur. So there's some greenfield areas, Western Sydney, Southeast Queensland, and, Central Coast, Wyong, Newcastle, out to Annandale, Maitland. You watch the markets move the next cycle off the back of this stimulus.
And once again, that's also some, when you say you invest in infrastructure, there's some great infrastructural spend there as well.
There is, yeah. There's lots of investment with roads. There's enormous employment hubs that, they've got great connectivity. We've got a great parcel of land at Sharmhaven, and we can deliver land there for half the price from Northwest Sydney, and it's the same travel time from Northwest Sydney to North Sydney than it is from Sharmhaven to North Sydney. So why wouldn't you? You've got the lake, you've got the beaches, you've got Hunter Valley, you've got Newcastle. If I was a young family, well, I could go and spend double the amount on land, most probably a little bit more on the build because it's Sydney prices, or I can go out to an area that's got great infrastructure, great transport links, and I can go and buy and build a house for literally half the cost of Sydney. That's where the market's going to move. And that's what I encourage people to do is, it's always nice to buy a one-bedroom apartment in Bondi, but are you going to get the same growth? I don't think so.
Look, it's investing in property is sometimes quite simple if you just break it down to your point, or to your points that we're going through. And one simple thing that you're sort of touching on there or covering is the sort of average household income to average price in that area ratio, right?
That's right.
And when the average income is a lower multiple to the average house price in that area, naturally it's got to play catch up. When I say a lower multiple in comparison to neighbouring alternatives.
Yep.
Right?
You bet.
I don't know if we quite got to 120,000 as the average income, but it's definitely jumped a lot, and some markets haven't seen that same price growth. So yeah,
it's all numbers, if you go, people encourage to just get on REA or Domain and have a look, but it's 2,500 a square metre for land in Sydney, right? In our catchment, northwest, southwest, it's between 2 and 2.5. But if you draw a circle of those and see where it hits around the Central Coast or Sharmhaven, Wyong, you can buy the same land that's got the same landscaping or the Instrument 88B, which is how beautiful the estate is, for half the price. It makes sense to me that as a family, that considering the cost of the issues with affordability, that wouldn't be something to consider. Now, what I need to do as a developer is move the needle and make it more desirable to go and live out there than try and hit yourself to an enormous mortgage and hope that you can rent it out, or you're going to move there and set your family up. So
is that pretty much all you'd want to cover in the government stimulus?
Yeah, I think that makes sense to me. The numbers don't lie. Like, let's face it, the government has to do something. There is going to have to be some sort of stimulus to allow them to hit those targets. And I am very interested to see how that happens, what plays out in this election. So let's watch and wait and see.
And lastly, economic conditions was the last driver that you've highlighted here. We've sort of covered it.
Yeah.
Interest rates is probably the biggest influence in the economic conditions. I guess also wage growth, unemployment, the global performance of the economy or locally in particular. If businesses are thriving, if businesses are profitable, then people can afford to spend more. If there's been good wage growth, same.
Yeah, a good way for me to answer it in my seat. So we have sovereign funds invest with us and our partners, right? Now, what sovereign fund is the money that a government makes that needs to invest. So pension funds, teachers funds from the US, and a whole range of in between. And I went up to Singapore and Hong Kong last year, met with a lot of our funders, and Australia is seen, we're so far away from all the issues in the world. There's some horrible things going on, up through the Middle East and into Europe. America's going through enormous change with Trump, a second term from Trump.
The Middle Eastern Riviera, you mean?
Yes. And look, the loving or loathe him, that country's enormous, and it does, when it catches a cold, the rest of us cough, right? So we need to navigate that. But my point is that all the money that makes the world go round looks at us as a very strong and stable, faraway market. And at the moment, they're all looking at the low supply, they're looking at the migration data, they're looking at the government stimulus and the planning, and they're all coming down to invest with us in housing.
Because we're a very buoyant market.
Yeah.
We're not like certain parts of America where there's fluctuations based on industries, with places like Detroit losing car manufacturing or it deteriorating and things like that.
Yeah.
We're sort of concentrated to a handful of cities, and these cities aren't subject to one industry collapsing.
That's right, and we're very safe for the wealthy elite that can send their kids down here to be educated, predominantly from Southeast Asia. So that's one of our biggest exports. We've got amazing resources, and we are the best country in the world, let's face it. So as a tourism destination, we're one of the best. So we've got a fair few big green ticks in the boxes for people that want to either, come down for a visit, send their kids here to be educated, or do business with us, right? So the consumer confidence off the back of interest rates, I think, is going to improve because there's enormous investment coming to living. And it's most probably the big thing to share. The way we look at markets is that we're targeting off the back of those 6 things, right? So then you've got to form a strategy around that.
Yeah, and let's segue into your strategy off the back of those drivers.
Things. So I'm going to use some suburbs that people may be familiar with. So let's use Manly, because there's some good numbers around Manly from 2023, 24, and what's going to happen in 25, right?
Love Manly. That's where I was working in the Commonwealth Bank during those
there you go.
GFC and stimulus sort of packages.
And it's a piece of paradise. Now, everyone's got opinions on it, but everyone wants to live in Manly. It's got the beaches, it's got the bars, it's got,
It's got great access to the city with the ferry.
It's just perfect. But the median in that place is $4.4 million. Like, it's a aspirational suburb. Now, when you look at the growth from last year, it was only, what is it, my eyesight over here?
Yeah, I'm not wearing my glasses.
Manly only grew 0.5% last year.
But is that because of what you just said? It's already expensive.
That's right. It's a premium suburb. So where's the market? Manly Vale, right? It's a couple of minutes drive. Let's face it.
It's the adjacent neighbourhood.
And it grew 10.7%. No, 10.1.
10.1. And let's highlight the two difference in medians. 4.4 is the average price in Manly for a house, and 2.95 is the average price for a house in Manly Vale, which is directly next to
100%. So then let's put my hat on as a developer and then me trying to sell it to a consumer. Manly Vale has some pockets that aren't that great, right? It's in light industrial and whatnot, but there is enormous investment from people like me that's going to go into a precinct in Manly Vale, and that ripple is going to have a major impact on the surrounding streets and suburbs. And that's what I'm encouraging people to look at. So a classic, I think, is Bellevue Hill. If you look at the numbers there, Theo, in 2023, right, it grew 12%. In 2024, it lost 8%. But when you look at Waverley, it grew 17.9%. And again, we've got to look at those areas. So there's pockets within Sydney that are going to perform. So when I look at projects, I go, it needs to be a location on the edge of a premium suburb. So I'm going to let the cat out of the bag. Crow's Nest is on the cusp of Mossman, on Cremorne, Chatswood. It's enormous values in property, and Crow's Nest is emerging as a great area to live or invest because of the infrastructure investment.
And going back to your comment about commercial buildings there, historically, this is a bit of an old thought, and it's changed a lot in the last sort of 5-10 years, but historically it was a commercial area.
That's right.
And it's always had some, some restaurants and some residential sort of benefits, you could say, with the local neighbourhood. But that has drastically improved.
It's evolving to be a great little village. It's got shops and restaurants, now got transport. Like you can get on that metro. My office is next door to it. You can get into Westfield in Chatswood in 8 minutes, like literally in the middle of that shopping centre.
It's got a very new age Woolworths there as well. It's got the 2 levels.
Yeah, it does. Crow's Nest, Gladesville, Marrickville. There is some pockets. There is going to be enormous investment in those areas, and there's going to be a major ripple. And when you look at Hunters Hill to Gladesville, it is chalk and cheese on the values. But you can literally drive across the road and you're at, the heart of Hunters Hill, and then you're on.
And let's go back to your point. I keep circling back to this comment. I like it. Invest in infrastructure, being follow infrastructure.
Yeah.
Crow's Nest is sort of at the forefront of multiple benefits of huge infrastructural spend.
Yeah.
You've already highlighted the metro.
Yes.
But then you've also got that whole Warringah Freeway upgrade. And then that hopeful, inevitable Northern Beaches link.
Yes.
Right. They did start digging the entry there, and they do have all the houses in the Northern Beaches which they've acquired, and they've parked them. They haven't sold them. They've leased them out to revisit the project at a future date. And I think it's only inevitable that will go ahead, because it's already built to connect all the way into the West Connects and North Connect. And you can basically go from French's Forest, once it's built, French's Forest to the airport pretty much underground.
And guess where Manly Vale is at the end of one of those?
Right at the end of Brookvale. Yes, that Brookvale exit.
It's a funny thing when you put the pieces of the puzzle together, get the data, whether that happens in the next cycle or not, but I agree, it will ultimately happen.
It has to happen, yeah.
But yeah, I think that I always say the investments in infrastructure, one. So anything with transport, then you combine that with amenity, health, wellness, and amenity. So we launched Linfield Coles. When I bought the site, the average square metre rate in Linfield was about 15,000 square metre. And on top of Coles, we nearly got 18,000 a metre, because people pay a premium to live above the convenience of Coles. And so we now, as part of our target as a developer, and anyone that's buying a piece of real estate should try and combine these ingredients, is it's transport, it's amenity or retail, and it's a good developer, and it's on the edge of a premium suburb. They're the ingredients that people are going to buy well and do well in property. And it all comes back to affordability. It's more affordable in those areas that I've highlighted, and they're going to benefit from the balancing, the levelling out of those newer suburbs that are emerging off the back of the premium suburbs that are established and will always be desirable to live in, play in.
You keep talking about markets I'm very familiar with, where I worked in. I actually worked at Linfield in the Coles Bank there as well.
There you go.
And I know from the average clientele there is a lot of sort of downsizers and retirees.
There is indeed.
And you're talking about proximity to Coles. They don't want to. Most of them don't want to hop in the car and go anyway.
Oh, it's amazing. We there was only 59 apartments. We sold 58 in 2 weeks. Some, talk to Dave Milton, who was part of that process with me. We most probably sold too cheap, to be honest. But that they were full of downsizers.
So when did you say that was?
That was about 2.5 years ago, 3 years ago.
And it's coming to completion.
It's the owners move in the next 6 to 8 weeks. So it's a classic example of this marriage of transport, convenience, and amenity, and that's what we're looking for as a developer. That's what our next cycle will be delivering in both mixed use or our communities, our house and land. So we'll be combining those elements with all our projects going forward, and we will do well as a developer, and our clients will benefit from that as well.
All right. Well, I think we've covered all those driving points. I'm just having a look. Was there some other topics that we wanted to cover? I think we've already sort of covered the alternative funds that you guys are doing, the NDIS and the SDA.
Yes.
Some of these are great for SMSF investing. We did a feature, you could say, of the SDA fund that you do, and we got some strong interest.
Yes. I think we've got a couple of clients investing in a asset class like SDA for people living with disability. It's got lots of risks and rewards attached with it. The risk is if that tenant's circumstances change, they can exit that property. We believe that the right way to invest, it's a great social investment as well, is to invest with someone like us that has a fund set up that allows you to invest, get annualized returns of 13%, paid quarterly. You're building houses for people with a disability. That's a great investment, right?
Let's elaborate on that, because I think there's a little bit of negative sentiment towards some of these developments, but that there's to use your language again that I like to use myself. There's chalk and cheese developments in this space, where some people are trying to convert certain houses to be NDIS, but if you purpose build it from the start, it's a different kettle of fish. And also, we all know about the blowouts in the government budget on these items.
Yeah.
But at the same time, for the right people that are in need of these facilities or disability housing, I should say, it's a huge cost saving long term for the government.
Oh, without a doubt. Like, our model is a 10-in-1 model. So we build 10 properties with one carer, and that one carer is then shared over the 10 participants.
Whereas sometimes people need a sole carer if they're at home and they're not in appropriate housing.
Right.
It's a lot more expensive.
Yeah, we save the government millions of dollars because our portfolio now is over 150. We've got mandates to build another 400. And the risk, just to back on that, there's a lot of spruikers out there that are trying to sell the dream of owning a house with 6 bedrooms that's going to have 6 participants that are all on high physical support. They aren't even compliant anymore. Once the government cracks down on the type of housing, that will not qualify for NDIS funding. So, the risk of that, there are some cowboys out there that are selling the dream that just will be a nightmare within the next couple of years as the industry catches up with all these operators that are doing the wrong thing. You've also got to have relationships with the people that have the participants in their care. So, it's most probably a whole nother podcast, but a lot of the housing that people are in is no longer fit for purpose. And it's part of many years ago, the government provided housing to the independent carers like Aruma and Livability and Possibility. And so the government housing is government owned, but they haven't spent any money to make it comply with the new code for the NDIS. That house is about to lose its funding. And so there are thousands of people that are living in that type of housing that needs to transition into new purpose-built compliant housing. And that's what we provide our investors, is a safe and secure way to invest in the creation of that housing, backed by all these independent SILs, these independent living advisors, and then we can build the house. The rent comes in, we pay our investors a really attractive return. And it's a great thing to be involved in long term.
And these independent living advisors,
yes,
they have very long-term leases in place for these facilities, right?
They do. So, but the government is not renewing a number of the leases because they need to spend money to upgrade them. And we actually,
they're not renewing the sort of outdated housing.
that's right. And we see the housing is most probably going to solve for social housing because you don't have the same high level of finish required for the NDIS or SDA. So we can see it's a balance sheet shuffle, is that housing will go out of the SDA world and it will get a bit of a renovation for someone that needs to live in social housing or affordable housing, and then all those people living with higher needs will transition into stuff that we and others good operators build. And that's the opportunity between now and 2029. There's thousands of properties that are going to end their life as SDA. And I think people that are interested in that space should reach out to you and talk about that platform that we've created.
Yeah,
you can introduce to clients.
Yeah, well, like I said, it's a fantastic investment that we're seeing a lot of clients use for their SMSF. Some of these units and other developments you've got going on have been attracting investors for their SMSF for the obvious benefits of depreciation and little to no maintenance when it's a brand new development. That's the one thing that frustrated me on some of my residential investments is that it's the maintenance requirements if they're not recently built. But look, Racer, Luke, I think we've covered a lot. It's a big segment today in today's session. So I don't think we'll dive any further into these points. That was some great insights. I think what I'd love to do is review these in 6 to 12 months, get you back on board.
Yeah, let's do it.
Have a look at where the market has landed in terms of interest rates, see some of the successes in your projects, and we can also look at this particular markets like Manly Vale and Crow's Nest and see what's happened there too.
You bet. Let's do it. Great to be here. Thank you.
Thanks for coming on board.
Cheers, mate.